Many countries around the world live in debt. It may sound strange, but it's a fact. The United States owes more than $30 trillion. Japan, around $10 trillion, and France, over $3 trillion. These are wealthy nations with strong economies, advanced technologies, and well-developed infrastructure, yet they carry massive debts, and they're not alone. Today, almost every country spends more than it earns. When a person takes out a loan, they eventually have to pay it back. If they don't, there are consequences. But countries work differently. They can carry debt for decades. No one demands full repayment right now. And what's even more surprising, they keep borrowing more. This doesn't cause panic in the markets, and these countries continue to grow. To understand why, we need to take a closer look at how government debt works. It's not just a budget deficit, it's a key part of the modern economy. In this video, we'll break down where debt comes from, who lends the money, why governments borrow, and why debt isn't always a bad thing. What is national debt? When a country spends more than it earns, it ends up with a deficit. It's like a household. If your income isn't enough to cover food, housing, and other needs, you have to borrow. Governments do the same thing, just on a much bigger scale. But unlike regular people, countries don't go to a bank to apply for a credit card. Instead, they issue special documents called bonds. These are like IOUs. Give us $100 now, and in a few years we'll pay you back more. Maybe $105 or $110. This is how governments borrow money from individuals, companies, banks, and even other countries. It's considered a safe investment because most developed countries usually repay their debts. Sometimes, countries also borrow from international organizations, like the International Monetary Fund or the World Bank. These loans are usually meant to help struggling economies, but they come with conditions: cut spending, raise taxes, or change certain policies. All of this borrowing adds up to what's known as the national debt. It's the total amount of money a country owes from all the borrowing it has done over the years. And the more it borrows, the bigger that number gets. But debt isn't always a bad thing. Imagine a government borrowing money to build new roads, schools, hospitals, or invest in technology. That kind of spending can make life better and help the economy grow. What matters is whether those investments actually pay off, not just disappear into waste. Problems start when a country borrows not to grow, but just to cover basic costs, paying government salaries, servicing old debt, or buying political support. In this case, debt grows while the economy stands still. It's like someone who takes out new loans just to pay off old ones. A dangerous cycle. Think of national debt like a heavy backpack. If it's not too full, you can keep moving. But the heavier it gets, the harder it becomes to go forward. And eventually, you might collapse under the weight. That's why it's not just about how much a country owes, but how it manages that debt. There's also something called the debt-to-GDP ratio, meaning how much debt a country has compared to its gross domestic product. That's the total value of everything it produces in a year. A wealthy country can carry more debt without problems. A poorer one can't. Just like a person with a high income can handle a big loan, but someone with a small paycheck might struggle with even a small one. So the real issue isn't whether a country has debt. Almost all of them do. The key questions are, how is that debt used? How well is it managed? And can the country afford to pay it back over time? Why do countries borrow money at all? Just like people, governments can't always live within their means. Sometimes spending goes far beyond income. That can happen for different reasons. And not all of them are bad. A country might urgently need to invest in infrastructure, healthcare, or defense, but doesn't have enough money in the budget. In that case, the government decides to borrow. One of the most common reasons for borrowing is development. Building roads, bridges, schools, hospitals, or power plants requires large amounts of money. These projects don't bring instant profit, but over time, they improve people's lives and strengthen the economy. It's an investment in the future. A country borrows to move forward. Another major reason is a crisis. During economic downturns, like in 2008 or during the pandemic, businesses shut down, people lose jobs, and government revenue drops sharply. At the same time, expenses increase. Support for the unemployed, hospitals, and emergency aid becomes critical. To keep the economy afloat, governments borrow and launch stimulus programs, known as relief packages. Countries also borrow to meet their financial obligations, paying pensions, salaries to public workers, funding the military, buying medicines, or supporting education. These are essential services. Sometimes tax revenue just isn't enough to cover everything. In those moments, debt helps the government keep things running without interruption. And finally, some countries borrow even when things are going well. Why? Because borrowing can be strategic. If the government can take a loan at a very low interest rate, it may make sense to fund important projects now rather than wait to save enough money. It's like being offered a $100,000 loan at 1% interest. You'd probably think, maybe this is a smart opportunity. So national debt isn't just money in the red, it's a tool. What matters is not just that a country borrows, but why, under what conditions, and how the money is used. That same debt can either boost a country's future or drag it down. It all depends on how wisely it's handled. Where does national debt come from? National debt starts with a budget deficit. This means a country is spending more money than it's bringing in. The government's main income comes from taxes on businesses, salaries, purchases, and property. But sometimes tax revenue isn't enough to cover everything, from pensions and public services to construction and previous debt payments. When expenses become greater than income, the government has a few choices: cut spending, raise taxes, or borrow money. Most often, it chooses to borrow. How? By issuing bonds. These are official documents that say, buy this now, and we'll pay you back more in a few years. Investors buy these bonds. Banks, corporations, other countries, and even regular people. Sometimes the government also borrows directly from the central bank, which can create money to fund spending. But this has to be done carefully, or it could lead to inflation. So, national debt isn't just a random number. It's the result of a country living beyond its means. Each year that expenses are higher than income, the shortfall becomes part of the debt. And if this continues year after year, the total debt keeps growing. Why is this considered normal? Today, national debt isn't unusual. In fact, almost every country in the world lives with some level of debt. It has become a normal part of the global financial system. Why? Because debt by itself isn't dangerous. It only becomes a problem when a country can't manage it. When there's not enough money to make payments, the economy weakens, and investor confidence drops. The key rule for measuring debt stability is comparing a country's debt to how much it earns, that is, to its gross domestic product, GDP. If the economy is growing and generating income, even a large amount of debt can be managed. It's just like a person with a high salary being able to pay a mortgage, a car loan, and still live comfortably. For example, Japan has carried a debt of more than 250% of its GDP for many years. But its economy remains stable, inflation is low, and investors still trust it. No one panics because Japan is considered a reliable borrower. The same goes for the United States, where the debt has passed 120% of GDP, but the economy is still the largest in the world, and U.S. bonds remain in high demand. This idea is called debt sustainability. As long as a country can make its interest payments and investors continue to lend, debt is considered manageable. Trouble starts when the economy slows down or political risks appear. Then even a small debt can become a heavy burden. That's why the most important thing isn't just how much a country owes, but how it uses the money. Whether its economy is growing, and if lenders still trust it. When all of that is in place, debt isn't a threat, it's a tool. And in that case, living in the red isn't a sign of weakness, but part of how the modern world works. Examples of good and bad debt. To really understand how national debt works, it helps to look at real-world examples. Some countries live with massive debt for years and still remain stable. Others fall into crisis even with smaller debt levels. It's not just about how much a country owes, it's about how it manages that debt and whether investors trust it. Japan is a classic example of good debt. Its national debt is over 250% of its gross domestic product, one of the highest in the world. And yet, the economy is stable, inflation is low, and the population stays calm. Why? Because most of Japan's debt is held by its own citizens and institutions, not foreign creditors. On top of that, Japan has strong industry, advanced technology, and a solid financial system. Investors believe Japan will pay its debts, so the level of trust is high. Argentina and Sri Lanka, on the other hand, show what can happen when debt becomes a problem. Argentina has defaulted several times, meaning the government officially said it couldn't make debt payments. The causes include political instability, weak economic control, and heavy reliance on foreign lenders. Every new crisis makes the debt burden worse. Sri Lanka recently fell into a similar debt trap. A shortage of foreign currency made it impossible to pay for imports, and then for its debt. This led to economic collapse, widespread protests, fuel shortages, soaring prices, and empty store shelves. It's a clear example that even moderate debt can turn into a disaster if the economy can't keep up and trust is lost. So debt isn't just a number. It can be helpful if used wisely to support growth, but it can be dangerous if a country relies on borrowing without a solid plan. What matters most is not how much a country owes, but how smartly it manages that debt. Conclusion. Should we be afraid of national debt? National debt sounds serious, even scary, especially when you hear numbers like $30 trillion for the United States or debt levels over 250% of GDP in Japan. You might wonder, how can any country survive with that kind of debt and not go bankrupt? But in today's world, debt is not just a burden, it's a tool. And like any tool, it can be helpful or harmful, depending on who uses it and how. Debt alone doesn't make a country weak or poor. It's like with people. Taking out a loan doesn't automatically mean someone is in financial trouble. What matters is what the money is used for, how it's repaid, and how well someone manages their finances. If a person takes a loan to invest in education or housing, it's a step toward the future. But if they borrow just to pay off old loans or spend on unnecessary things, that's a warning sign. It works the same way for countries. When a government borrows to build schools, hospitals, support the economy, or protect its citizens in hard times, that debt can be useful. It helps ride out crises, drive growth, and improve quality of life. But when debt is taken on without a clear plan, keeps growing year after year, and the economy isn't improving, then it turns into a real problem. Good management makes all the difference. Skilled economists, transparent budgets, and trust from both citizens and investors allow a country to manage debt wisely. Even large debts can be sustainable when there's stability and a clear plan. But in places where policies change constantly, plans are unclear, and decisions are made emotionally, even small debts can lead to major crises. And we can't forget the citizens. In the end, they are the ones who feel the real effects of national debt. When a country spends more than it can afford, the pressure often shows up in the form of higher taxes, rising prices, lower pensions, or cuts to public services. So national debt isn't just some distant number. It can directly affect people's everyday lives. So, should we fear national debt? The answer is no, if it's well managed, transparent, and used responsibly. But yes, if it's ignored, misused for political gain, or spent without a purpose. Just like in personal life, borrowing is normal if you know how to repay it. You have a plan and you're thinking ahead.